What is risk tolerance? Risk tolerance refers to your ability and willingness to accept a drop in the value of your investment. When determining your risk tolerance, consider how comfy you will feel preserving your positions if the stock market falls dramatically. In this video, let's enroll everything you need to know about risk tolerance. Types of risk tolerance. Aggressive risk tolerance. When an investor has an aggressive risk tolerance, most of their portfolio is allocated to riskier assets such as stocks and real estate. These have the potentials for higher returns over time. The time factor, on the other hand, is critical. The investment is more likely to lose value in the interim. There is no guarantee that an investor will receive their money back. Being aggressive entails being willing to accept the possibility of losing some or all of the principal. Moderate risk tolerance. A moderate risk tolerance keeps one foot in conservative and aggressive camps. The traditional 60-40 allocations between stocks and bonds is a classic example. This strikes a balance between some money invested for growth and some invested for income generations. Conservative risk tolerance. An investor with this attitude is concerned with capital preservation and avoiding downside risk. Naturally, lower returns are the result, but the investor is willing to accept them to prevent wild price swings. A certificate of deposit, for example, is a very conservative investment. In exchange for keeping an investor's money locked away for a set period, a bank or credit union will guarantee a specific rate of return. The promise of a return is an advantage. Still, the low earning potential can be a disadvantage. In addition, an older investor nearing retirement will most likely have more conservative risk tolerance. How risk tolerance works. When stocks are rising, anyone can have a high risk tolerance. However, it is the best time to assess your risk tolerance when the market is falling. Consider the month of March 2020, the stock market plummeted. Unemployment has skyrocketed. The world faced unprecedented levels of uncertainty, fearing that COVID-19 would devastate the economy. What was your risk tolerance like back then? Did you persevere in the face of adversity? For example, your risk tolerance was low if you sold stocks during the panic. Or were you willing to invest more to capitalize on the market's decline? If so, your risk tolerance was high, and it has served you well as the stock market continues to set new highs. Why risk tolerance is so important? Your risk tolerance is critical in developing a game plan for growing your money without worrying about it daily. Suppose you don't have the stomach for the risk of losing your principal. Even if it's only temporarily, you have to settle for lower risk investments and the lower returns that comes with them. Higher returning investments are frequently associated with a higher risk of sudden downturns or outright loss. With a better understanding of your risk tolerance, you can develop an investment strategy that will help you balance the risk of volatility and the potentials for higher returns in the long run. So that's all. Stay tuned and subscribe for more.